they're doing a big U-turn and going back because they don't want the goods because 145% tariff. But at a certain point, I hope we're going to make a deal with China. We're talking to China, but their factories are closing all over China.
China is drowning in debt. Or is it? While headlines scream crisis, a much stranger, deeper reality lies beneath. Trillions have been borrowed, but trillions more may be quietly owned. How can a country carry one of the world's largest debt loads and still borrow at record low rates? Why are investors buying bonds that barely yield more than nothing? And what if this entire system is held together by assets you've never heard of, and risks no one wants to talk about?
This is going to be a long struggle, and part of it is because I think Xi Jinping has boxed himself in. He has configured the Chinese political system so that only the most hostile answers are considered to be acceptable.
China has experienced one of the most dramatic economic rises in modern history. In just a few decades, it has gone from a largely agrarian society to the second largest economy in the world. A key part of that story has been exports. For years, China has produced and sold an enormous volume of goods to the rest of the world. Everything from electronics to clothing, machinery to furniture. If you pick up almost any item in a home or office today, there's a good chance it was made in China. This made the country the workshop of the world and brought in a staggering amount of wealth.
So this is not going to really hurt Boeing too much in the long run. And if President Trump, if he starts putting an embargo on the sales of parts to China, because that is the natural step, then, you're going to have a lot of planes in China are not going to be flying pretty soon. So, this is not very good for China because they haven't thought this out.
But unlike many other countries, China didn't use that wealth in the way you might expect. In most developed economies, money from exports tends to circulate through consumer spending or investment in diversified financial assets, like stocks, mutual funds, or private equity. That hasn't really been the case in China. Despite its increasing prosperity, the Chinese population hasn't developed a strong culture of consumption, and the domestic stock market, while significant in size, has remained mostly underutilized by ordinary investors. So with all this money coming in, and little of it flowing into consumption or public equity markets, the obvious question becomes, where is it all going? For a long time, the answer has been real estate. Property investment in China has played a far bigger role than in most other economies. In fact, Chinese real estate is now considered the single largest asset class in the world. Over the past 2 decades, as China's export economy boomed and household savings remained strong, a significant portion of that wealth was funneled into property. Real estate wasn't just a place to live. It became a primary way to store and grow wealth.
So also they got their debt crisis. Their 2008 in slow motion is occurring now. You got the collapse in the property prices that have already occurred. And the other thing is that Xi Jinping has turned his back on consumption as the basis of the Chinese economy. So his only way out is to export more. President Trump has just closed off the world's biggest consumer market by far. I don't know what Xi Jinping's going to do because Chinese factories have been closing now, and this is just a crisis for him.
The government's role in this can't be overlooked. Chinese authorities encouraged real estate development as a way to stimulate growth and urbanization. Developers were given easy access to credit. Land sales became a major source of income for local governments, and owning property became deeply embedded in Chinese culture. For many families, buying a home wasn't just about securing a place to live. It was a financial necessity, an investment vehicle, and even a way to signal social status. But this massive shift into real estate hasn't come without consequences. One of the most pressing issues is affordability. Economists usually consider housing unaffordable in a city if the average home costs more than 5 times the average annual income. To put this into perspective, in Los Angeles, that ratio is around 7.5 times. In Sydney, it's closer to 13. And in London, it's about 19. But in Beijing, the average home costs roughly 35 times the average income. This puts property far beyond the reach of most ordinary residents. Despite high prices, many people have continued buying homes, often several, not to live in, but to hold as investments. This has created a speculative property bubble, where demand is less about need and more about expectation of future gains. And with very few alternative investment opportunities available, especially for retail investors, real estate has effectively become the only asset class that many people trust. This situation has led to another major issue: household debt. Chinese households are taking on increasing levels of debt to finance these property purchases. Much of that debt is in the form of mortgages, with people borrowing large sums just to get a foot on the property ladder. In a country where saving has traditionally been a point of pride, this growing reliance on credit is a significant shift. At the same time, the supply side of the market has exploded. Entire cities have been built in anticipation of future demand, leading to so-called ghost cities, areas full of high-rise apartments with few residents. Developers took on mountains of debt to fund construction, and local governments relied on land sales to keep revenues flowing. It created a self-reinforcing cycle that now appears increasingly unsustainable. The broader economic effects of this are even more complex. While property prices have soared, prices for most consumer goods in China have remained flat. Over the past 25 years, China has seen very little inflation in the traditional sense. That might sound like a good thing. After all, stable prices help protect consumers from losing purchasing power. But in practice, it signals a major imbalance. Essentially, China has become extremely efficient at producing goods, but not very good at consuming them. This creates a situation where supply outpaces demand, and the natural result is deflationary pressure. Consumers aren't spending enough to keep up with what's being produced. When this happens, companies have less incentive to invest in growth or innovation, which can lead to economic stagnation over time. In developed economies, inflation often acts as a motivator. People are encouraged to invest or spend because they know money will lose value over time. In China's case, the opposite is happening. People are saving aggressively, largely to buy property, which in turn limits their day-to-day spending. As a result, a huge chunk of the economy becomes tied up in unproductive assets, homes that sit empty, buildings that don't generate any economic activity, and loans that rely on future appreciation to make financial sense. It's a fragile system, and one that's become harder to maintain as growth slows and debt levels rise. And this brings us back to the original question: where is all the money going? The answer largely is into the ground, quite literally. It's going into homes, office towers, and infrastructure projects, many of which may never generate enough return to justify their cost. This isn't just a story about overbuilding. It's a story about how a country with immense wealth has struggled to turn that wealth into long-term, sustainable prosperity. While international investors and economists have long admired China's ability to grow at such rapid rates, the internal structure of that growth has started to show strain. Real estate may have been a convenient place to store wealth during the boom years, but as demand cools and debt mounts, the risks become much harder to ignore. While China's real estate boom helped drive decades of impressive growth, it has also exposed some deep-rooted problems within the country's economic structure. One of the more surprising outcomes of this model has been deflation. That's not something you hear about very often, especially not when we talk about rapidly developing economies. But in China, it's a major concern. To be clear, deflation is not simply the opposite of inflation. It's not just falling prices. It's what those falling prices represent. At its core, deflation means weak demand. When prices aren't rising, and in some cases are actually falling, it suggests that consumers aren't spending enough. Businesses see less incentive to invest, expand, or even maintain their current output. Growth slows down, and the entire economy can start to stagnate. Over the last 25 years, the prices of everyday consumer goods in China have been remarkably stable. At first glance, this might appear to be a sign of economic health. Low inflation means the currency maintains its purchasing power, and consumers are shielded from the kind of cost of living increases that plague many other countries. But when prices stay flat for that long, especially in a fast-growing economy, it begins to reflect a deeper imbalance. China has a very high savings rate. Households save far more than their counterparts in Western countries. This is partly cultural and partly structural. There's less of a social safety net in China compared to Europe or the United States, so families are more inclined to save for healthcare, education, or retirement. But more recently, much of this saving has been directed toward one thing: buying property. People are not just saving out of caution, they're saving to afford homes that keep getting more expensive. This has shifted consumption habits across the country. Young people are putting off spending, delaying marriage, and reducing their day-to-day purchases to save for deposits. And once they've bought a home, many are still reluctant to spend, as mortgage payments eat up large portions of their income. This creates a cycle. Weak consumer demand keeps inflation low. Low inflation allows banks to lend money at low interest rates. And easy lending encourages more borrowing, often to fund more real estate development. It's a self-reinforcing loop, and one that China has relied on heavily. Now, in most economies, printing large amounts of money would inevitably lead to higher inflation. More money chasing the same amount of goods tends to drive prices up. But China's situation is different. Despite years of aggressive lending and stimulus, consumer prices have stayed low. This is largely because that extra money hasn't gone into consumer goods. It's gone into assets, especially property. From 2000 to the end of 2019, the money supply in the United States, specifically the M2 money supply, which includes cash, checking deposits, and easily convertible near money, roughly tripled. That's a significant increase. But in China, the same measure increased 16 times over the same period. That's not a small difference. It means China's money supply expanded over 5 times faster than America's. Normally, such an increase would cause serious inflation. But in China's case, this money hasn't filtered into households in the usual way. It's mostly been created by state-owned banks, who issue loans to local governments, state-owned enterprises, and large developers. That money goes into infrastructure projects, industrial facilities, and of course, real estate. When China wants to inject money into the economy, it doesn't rely on international investors or bond markets the way most Western countries do. It simply uses its state-controlled banks to create credit. These banks are not truly independent in the same way as commercial banks in market-driven economies. If the government wants them to lend, they lend, often to government-owned borrowers. This system works to a point because inflation remains low and interest rates stay manageable, and it creates the illusion that the government can borrow endlessly without consequence. But that isn't quite true. What China has done is expand its balance sheet massively, especially at the local government level. This debt doesn't always appear in the official numbers, but it's there, hidden in local government financing vehicles, off-budget borrowing, and state-owned enterprise liabilities. According to the most optimistic estimates, China's total debt-to-GDP ratio has already crossed the 300% mark. That number is usually associated with countries in severe financial distress. The problem isn't just the size of the debt, it's the structure of it. Much of it is owed internally between different branches of the government or state-owned entities. But that doesn't make it disappear. It still represents a claim on future resources, and at some point, someone will need to pay it back or write it off. This is where things get tricky. On one hand, China is uniquely positioned to handle this type of debt. It controls the entire financial system. Its central bank, commercial banks, and most large corporations are all ultimately tied to the state. That gives the government incredible flexibility. It can restructure loans, delay repayments, or roll over debt without facing the kind of financial panic you might see in more open markets. On the other hand, this level of control comes with limitations. If the property bubble deflates too quickly, or if consumer confidence falls, the entire system could seize up. Because so much of the economy is built on rising asset prices and easy credit, any major shift in sentiment could have cascading effects. The fact that consumer prices have stayed low, while asset prices, particularly in real estate, have soared shows where inflation is actually gone. Economists often say that if you pump too much money into an economy, you'll eventually see inflation. That's true, but inflation doesn't always show up where you expect it. In China's case, it hasn't shown up in groceries or fuel. It's shown up in homes that cost dozens of times the average salary, in cities filled with empty buildings, and in projects that may never produce meaningful returns. So is this sustainable? In the short term, possibly. As long as inflation remains low and the government retains tight control over the financial system, China can keep creating money and rolling over debt. But over the long term, this creates a fragile structure. If household confidence drops, or if inflation does start to creep up, the system could become much harder to manage. One reason why China has been able to borrow so much internally without triggering a crisis is that international demand for its bonds is limited. Unlike the United States, which sees strong global demand for its government bonds, China struggles to attract foreign investors in the same way. That's partly due to concerns over transparency, political risk, and currency controls. As a result, most of China's borrowing happens internally, among institutions that are essentially controlled by the same political structure. This can be a strength, but also a major weakness. If internal confidence erodes, the system doesn't have external capital to fall back on. And while central control gives the government tools to manage crises, it also means that bad decisions can scale up quickly if left unchecked. In the next part, we'll look at how China's government might be able to offset some of these risks. Unlike many Western nations, China actually has a large and growing pool of government-owned assets, including land, utilities, and state-owned enterprises. These could provide a path out of the debt trap if managed carefully. But that's a big if, and one that depends on political will, market conditions, and continued control over the financial system. For now, China's economy remains stable, but only just. Beneath the surface, a huge amount of debt, speculation, and policy experimentation is shaping the future. Whether it leads to a soft landing or a more severe reckoning is still unclear. But one thing is certain: the system can't keep expanding forever. Sooner or later, something has to give. China's economic model has spent decades built on rapid infrastructure growth, surging property development, and aggressive credit expansion. Yet beneath this facade lies a complex mix of assets, liabilities, and vulnerabilities. And whether this model is sustainable depends on more than just debt-to-GDP ratios. China's debt is unusually hidden within state-controlled structures. Local government financing vehicles, LGFVs, state banks, and at least 867,000 state-owned enterprises funnel credit through off-budget channels to support development projects and meet policy goals. LGFVs alone may hold between $7 trillion and $11 trillion in debt, with an estimated $800 billion at high risk of default. It's difficult to track such debt transparently, yet collectively it feeds into the overall picture, suggesting China's total debt could exceed 300% of GDP when all liabilities are considered. Despite these figures, China has been able to borrow at remarkably low rates. A 10-year Chinese government bond currently yields around 1.7%, compared with roughly 4.3% for a U.S. Treasury bond, creating a massive gap of around 2.5 percentage points, the widest in over a decade. In fact, long-term Chinese yields have even fallen below those of Japan for the first time ever. This disconnect raises serious questions about market perception and structural stability. One major reason behind this yield anomaly is China's tight control over its capital and financial system. Strict capital controls prevent most domestic and institutional investors from participating in international markets, effectively forcing them to lock capital into Chinese bonds and assets. With few other safe assets available, demand for government bonds remains high, even if yields are very low. At the same time, bond yields serve as a reflection of both expected inflation and economic growth. China's downward yield trend is in part shaped by falling growth prospects and persistent deflation. Consumer prices have remained essentially flat for years, And in fossilizing comparisons to Japan, some commentators label this China's Japanification, a deflationary spiral reinforced by weak domestic demand and demographic decline. Deep market pessimism is visible. Reddit users and finance forums have described China's bond market as pricing in a bleak outlook. Very bad future expectations. Investors think there will be a deflation spiral and lack of growth. Bonds are seen as a safer store of value than equities or businesses in such an environment. An important structural element is also the role of local banks. As government debt servicing policies push local banks to buy government bonds and other instruments, lenders are facing rising exposure to risky government obligations, and this can crowd out private lending and weaken bank asset quality. Yet even with these structural risks, China's government moves to reframe the narrative from one of debt to one of national assets. In 2025, Premier Li Qiang signaled a shift toward a broader balance sheet approach. Estimates from the Chinese Academy of Social Sciences put gross government assets at around 184 trillion yuan, or approximately 136% of GDP, by the end of 2023. The central bank has echoed those numbers, suggesting China's net assets may even exceed liabilities once everything is accounted for. This asset framing is not just rhetorical. Local authorities have begun leveraging state assets, such as stakes in listed SOEs, for financing or collateral, in lieu of traditional land-based borrowing. Some provinces have even transferred government-owned corporate equity into financing vehicles to support debt issuance and debt servicing. State-owned enterprises play a critical role in this asset-backed structure. According to SASAC, in 2023, SOEs had combined assets of nearly 871 trillion yuan, equivalent to about US $116 trillion, with revenues of US $12 trillion and profits around 4.6 trillion yuan. These firms generate dividends, provide employment, support industrial policy, and in some places act as direct sources of public revenue. Their value can technically be tapped through dividends, sales, or even asset disposals. For context, estimates from the Bank for International Settlements and Academic Research suggest China's public net worth may lie anywhere between US $20 trillion and US $40 trillion, offsetting much of its extensive debt. That brings a different angle. Rather than being purely indebted, China holds a massive portfolio of state-controlled assets that are theoretically liquid and monetizable. Of course, this model comes with its own risks. One-time asset sales or leveraging dividends can provide relief, but they are not sustainable long-term fiscal paths. Asset disposal at fire sale prices can devalue the assets themselves, and political realities may limit how aggressively Beijing can resort to these measures. Moreover, accurate valuation of these assets is notoriously difficult, and transparency remains limited. The broader implication is that China has built a debt-intensive system that depends on asset-backed credibility, internal banking loyalty, and capital controls. But this system is only stable as long as inflation remains subdued, bond yields stay low, and political structures remain aligned. If any of those conditions falter, say, if inflation begins to rise, consumer confidence plummets, or demographics erode growth, the model could unravel. The real estate bubble, for instance, has the potential to inflate suddenly and burst, triggering defaults in LGFVs, damaging local banks, and undermining investor trust. In contrast, many Western economies depend on household wealth and public consumption to underpin their public debt. In the United States, federal debt is closely correlated with household financial wealth, meaning adjustments to the former typically involve shifts in household income, spending, or taxation, and that's politically and economically fraught. China's approach avoids household extraction because most debt finances public-owned assets, land, infrastructure, SOEs, so repayments or write-downs could be managed internally, at least in theory. That creates a distinct separation between government liabilities and individual consumer burdens, one that is unusual among large economies. Yet it also concentrates risk within the state and financial institutions, making the system brittle if confidence breaks. The low interest rate environment has been a linchpin. A large debt burden at 1% costs no more in servicing than a smaller debt at 4% would. But the structure of lending is uneven. Central government debt gets the lowest rates, provincial and local borrowing carries higher costs, and SOEs may pay as much as 10% on certain debts. Managing these layers under different risk and rate regimes adds complexity and fragility. If inflation eventually finds its way into consumer goods or wage costs, China could face higher rates across the board, making its massive debt far more burdensome. The very thing that has kept its debt under control, low rates and internal credit circulation, could become its Achilles heel if conditions change. To summarize, the Chinese economic system is deeply unconventional. It combines extreme debt, suppressed domestic consumption, extensive state asset holdings, and rigid financial control into a model that seems to hold, provided certain conditions remain intact. But those conditions are fragile. A shift toward inflation, demographic decline, or erosion of confidence could expose the system's vulnerabilities rapidly. International observers and investors may admire China's ability to borrow cheaply and generate growth, but the underlying structure is opaque, heavily state-driven, and reliant on asset-backed credibility. Debt here doesn't always mean the same as in more open economies. It's a different form of debt, backed by different assets, and dependent on different incentives. Whether China's model leads to a soft landing or a sharper correction will hinge on future policy decisions, transparency reforms, and how well officials can manage internal risk, especially as the rest of the world watches closely.